We're just going to be waiting a few more minutes for anyone who's still joining us. Hello, everyone. I'd like to welcome you all and thank you for joining us on our latest edition of our webinar series for board members, property managers, and related professionals. Our exciting topic today is operating surpluses, what you need to know. My name is Jessica Chalkowski, and I'm a supervisor here at Wilkin & Gutton Plan, and I will be your moderator for today's program. I've been with the firm for almost 7 years, and I work with many community associations providing audit, review, and other consulting services. We have two outstanding speakers today who will be sharing their knowledge with us. First, we have Jordan Burkhalter, who joined the firm in 2009. He divides his time between working with clients in the real estate industry, including community associations, the medical industry, as well as closely held businesses. Jordan works with his clients to provide various services, including audit, compilation, and review engagements, tax planning, and other consulting services. Our second speaker, Carol Koransky, joined the firm in 1993 and is a principal in the audit department. She specializes in providing services to clients in the real estate industry and closely held businesses, including community associations and co-ops, where she provides audit, compilation, review, as well as other consulting services. Carol is also a current member of the Legislative Action Committee with CAI. We are very lucky to have these two with us today, so thank you so much for joining us. Before we get started with today's program, we have a few housekeeping items to discuss. If you have any questions at all today, please use the questions pane. This is in the GoToWebinar dashboard at any point during this presentation. We will try to get as many questions as possible in before the end of the presentation. Next, if you have any lingering questions that we have not yet answered, the final slide of the presentation does include all of the contact information for both of our speakers. The webinar is being recorded and will be on our firm's website, www.wgcpas.com. You will also receive a copy of the presentation via email shortly after the presentation. You will be receiving an email with a survey also after this presentation. We greatly value your feedback and would really appreciate it if you can give us your honest feedback, suggestions, any other information that you'd like to provide us with. Lastly, there are a couple of polling questions during this presentation. These will help us understand our audience as well as your experience. Our first polling question is currently on the screen. Please respond appropriately so we know who we're talking to today. Okay, great. So we have about half of our audience as board members, some managers, club leaders, as well as other professionals. Welcome, and thank you so much again for joining us. So what are we going to be talking about today? Operating surpluses. Jordan and Carol will both be covering the importance of an operating surplus, the implications of having an operating surplus, as well as ways to utilize the operating surplus for the betterment of the association. Jordan, take it away.
Thanks, Jesse. We will first be discussing today what is an operating surplus. At the end of the year, when the books are closed, the operating profit and loss will either end up with an operating deficit or an operating surplus. A surplus is generated by excess operating revenues over operating expenses. These excess funds will be carried forward to future years, which will become known as the operating surplus. Having an operating surplus is a great situation for an association to be in, because it allows the association to manage cash flow requirements throughout the year. An operating surplus can either be intentionally planned by the board or can be unanticipated. An intentional surplus can be created through the budget process. A board may know that the association has a large project or large expenses that are coming up in the next year. By creating a budget with an operating surplus, it allows the board to carry the surplus to the next year to use the funds when these expenses come up. By planning ahead, it's a great way to avoid increasing maintenance fees or passing special assessments to fund these projects. When the board examines the financial results at the end of the year, they may find that the operating revenues exceeded the operating expenses for the year, and a surplus exists when it wasn't anticipated. The board will then have to determine if this is an actual operating surplus or if it is simply the result of a timing difference. What I mean by a timing difference is the board may have budgeted for some expenses to occur in the current year, but as we all know, everything doesn't always go as planned, and sometimes things get pushed out or postponed. Therefore, the operating surplus that remained at the end of the year will quickly be utilized when these planned expenses are incurred in the next year. On the other hand, the operating surplus at the end of the year may be an actual surplus generated through cost-saving initiatives or unanticipated revenues received by the association. Not all expense line items are fixed costs. Many are variable costs that fluctuate throughout the year based on the association's actual needs. The association may have been able to save operating funds if expenses came in under budget, or the operating surplus may have been created by the association receiving a larger than expected township reimbursement, perhaps a settlement with the developer, or really any other unbudgeted revenue. This is the kind of operating surplus that will need to be monitored closely and eventually utilized, which we will get into a little bit later in the presentation. An operating surplus is very important to the financial health of an association. It allows the association to manage the ebbs and flows of expenses throughout the year. Not all operating expenses are incurred evenly throughout the year on a monthly basis. Some expenses are cyclical expenses and only incur at certain times during the year. Take, for example, snow removal, landscaping, and insurance expense. Snow removal services are often very large expenses depending on the size of the storm and are incurred over a short period of time. Landscaping expenses are only incurred between 8 to 10 months of the year, and when everyone knows when the insurance premiums come due, you have to have a large deposit for that insurance policy. By having an operating surplus, it will allow the board to have funds available to pay for these expenses, even though they may exceed the amount of operating maintenance assessments that are collected over the same period of time. Operating surpluses also provide for any unforeseen emergencies. Unfortunately, when the budgets are being created, there is no crystal ball that will tell the board every expense that will occur during the year. Even the most thorough budgets will have expenses that were not planned and will require immediate attention. For example, there may be a bad snowstorm or hurricane that will require storm cleanup or cause damage to common property, such as roofs throughout the association. The board will have to address these repairs so that way they won't snowball into larger problems down the road. Again, having an operating surplus allows the board to fund these situations as they arise. The final operating surplus will allow the board to manage expenses when they go over budget. As we all know, If there's not a fixed contract, it is impossible to accurately predict how much some expenses will be incurred during the year. Take, for example, general maintenance or utilities. We'll never know how many repairs need to be made during the year, if it's going to be a hot summer and need more electric, or it's going to be a cold winter that requires, more gas use. The existence of the surplus will allow for some breathing rooms with the fluctuation in expenses when they do run over budget. Now, knowing how important it is to have an operating surplus, the most common question that we get is, what is a reasonable operating surplus for an association to maintain? Unfortunately, there is no one-size-fits-all answer, and is on an association-by-association basis. A great starting point is to determine what a reasonable percentage of current operating maintenance assessment is required for the average monthly expenditures of the association. Take, for example, you may decide that you need 2 to 3% of maintenance assessments to cover the association's monthly expenses. At the end of the year, you can examine where you ended up. Maybe that surplus was too high and the surplus was too large and you didn't need it all, or maybe it was just the opposite and it wasn't enough, funds were still tight, and you were still scraping by. This is when the board can adjust that surplus based on the history of actual expenses that occurred and adjust that surplus to fit the needs of that particular association. Now that we know the importance of having an operating surplus, I will talk about some of the implications that they present. When unit owners pay their maintenance fees, a portion gets allocated to the operating fund, reserve fund, and whatever fund the association has. The portion that gets allocated to the operating fund gets expensed utilizing the pay-as-you-go philosophy. That philosophy means that the unit owners expect that their operating maintenance assessments will be utilized to fund operating expenses that benefit the association during the time that they live there. Even though having an operating surplus is necessary, when that surplus becomes too large, it starts to violate this pay-as-you-go philosophy. In theory, the operating surplus that's getting carried from year to year was generated in the past by prior unit owners. That surplus by prior unit owners is now paying for current expenses. Therefore, the current operating expenses that are being paid by current residents are being stashed away for future operating expenses when those unit owners may no longer live in that association. But please keep in mind, this is the exact opposite philosophy for the replacement fund. Maintenance assessments that are allocated to the replacement fund are expected to replace common property elements sometime in the future. Residents are paying for the benefits derived while they live in the association and receive a benefit of the common elements. Another implication of excessive operating surplus is people will start questioning if maintenance assessments are set too high. Why am I paying so much in maintenance fees when they're not even being needed to fund expenses? If large surpluses are continuously generated, it may be time to take a close look at the accuracy of the operating budget. Some revenue line items may need to be bumped up if they have consistently been above and beyond what was budgeted. And on the flip side, some expense line items may need to be decreased if they are always coming in under budget. It is easy to carry forward line items in the budget from year to year, but they need to be adjusted based on the history of actual expenses. This will give you an opportunity to lower the expenses and raise the revenue line items to fit the needs of that association. If an association is currently consistently generating these operating surpluses year after year, to prevent the operating surplus from becoming too large to manage, this might be an opportunity to reduce maintenance fees in the next year's budget. If that's something you're not comfortable with, you may be able to include it in the budget to mitigate any increase in maintenance assessments. We're now going to go to our second polling question. And Jesse?
If you have had an operating surplus in the past, what have you used it for? Additional replacement fund contributions, a refund or to offset maintenance assessments, or nothing, no operating surplus is too large? And we'll give you a few seconds to respond to that. Okay, so most of you either think that the operating surplus has been used for additional replacement fund contributions, or nothing, no operating surplus is too large, or lastly, refund offset maintenance assessments. So now we're going to get into a little bit more detail on maybe some options for the future.
Okay, thank you. All right, so now that Jordan's explained what an operating surplus is and how one is generated, we're going to talk about potential ways of utilizing the operating surplus and what makes sense for your association. So the first thing is, there's a few different ways, so we'll go through them one by one. One of the ways of utilizing the operating surplus is to actually return the surplus to unit owners. Now, that's not that common, but sometimes it actually does occur, and sometimes it might make sense. For example, if you're in an association that is just starting out and you maybe have developer paying maintenance fees and you end up with a large surplus because perhaps the initial budget might not have been exactly correct, well, then it might make sense to actually give back some of the fees. In general, that's not something that we see too often. Something that we see a little bit more frequently is including the operating surplus as revenue in the next year budget. Now, I wouldn't recommend using the entire surplus in the next year budget, but to pretty much plan and use that surplus over a few years. You don't want to artificially reduce maintenance fees because then the homeowners will have an expectation of lower fees than what are really necessary to fund the expenses. So sometimes you can take a look at that operating surplus and say, all right, let's use a piece of it over the next couple of years. And that will help to mitigate some of the increases in maintenance assessments. And again, if you were over budget on something in the prior year, you could use this surplus for that. Or if you're ending up in the current year, a large snowstorm happens early in the year or some other large expenditure occurs, then you could be using that surplus to offset that special assessment. So you can kind of use it, over a period of time to offset or offset an increase in maintenance fees and kind of subsidize maintenance fees. Again, you never want to lower maintenance fees to artificially set them at too low of a level, because then an expectation is there that fees are going to be so low, and then once you end up with using up the whole surplus, all of a sudden you may have like a huge increase in fees, which could be a problem. So you always want to try to smooth things out. Okay. So another way to use the surplus is including additional contributions to the replacement fund in the subsequent year's budget. So if you have been a little bit neglectful, or maybe you just didn't have the funds, or you just were short on cash and you couldn't make prior year funding, this is a good opportunity for you to increase contributions to be in line with your engineering study. If you were at 5% funding, maybe now you want to up it and go to 10% funding. If you just were just not even in sync at all, this would be an opportunity to do that. Also, it's important to always be taking a look at what the fund balance is that the engineer has anticipated for you to be at any point in time. And if you see that your actual fund balance is less than what the engineer had anticipated at a set date and time, then this would be a good opportunity to add additional contribution to bring it up into line and to be in line with the engineering study. Now, a lot of times we'll be, presenting the audit, and boards will say, or management will say, all right, well, let's just transfer that surplus over this year into the replacement fund. Unfortunately, for tax purposes, that's not the best way to treat it. Any contributions to the replacement fund should really go through the budget process. And that way, all unit owners are notified of the contribution. So we'll usually recommend that if there is a surplus and you want to have a contribution to the replacement fund, that you do it in the subsequent year budget. So,
Carol, we have a question coming in. Sure. Can we use the operating surplus money for just a replacement fund project?
Sure. If you have a surplus in the current year and you say, okay, you know what, I want to do, I want to use some of the money for a project like concrete or paving or something like that, you can charge some of those costs to the operating fund. That, you would just charge it right to the operating fund. So, so that you can absolutely do that. You can never charge operating expenses to the replacement fund, but you can charge certain replacement costs to the operating fund. You just want to be careful about doing that because, you are collecting funds in your budget each year for replacement needs, and you've told all the unit owners that you're collecting funds for replacement needs, so you want to be careful that you're not mixing things up too much.
Carol, we have a couple more questions coming in as well about the tax implications or the general implications of transferring to the replacement fund from operating surplus.
So I am going to get into the tax implications in a few slides, so we'll just table that question just for a couple minutes, and hopefully I'll address all of that. So there are definitely implications, and so you want to make sure that you're doing it the correct way. Okay, but I'm going to get into that in just a couple slides. Okay, so we talked about the fact that, maybe we're going to make up for past problems. It's also an opportunity to contribute above and beyond the study to the replacement fund. So, we recommend always that studies be updated every 3 to 5 years, so they're relatively current. But, a project could even be happening sooner than anticipated in the engineering study. Let's say if you're in your 3rd or 4th year and something deteriorated sooner than expected, then a large project might be happening sooner than had been anticipated in the engineering study. So even though you've been contributing what the study said all along, and your fund balance is in line with what the engineer says, if you know you're doing something sooner than expected, then you might want to contribute an additional amount. Also, it provides a cushion when anticipated costs exceed expected costs. So, the engineer might have come up with a cost for paving, and then in the meantime, oil prices spiked, and therefore the cost for paving could be significantly higher than what had been set aside. So you could use the surplus also to beef up your replacement fund for those types of circumstances. So you might have been doing everything right all along, but you might still be having a little bit of problem funding replacement expenditures. So that would be another good reason to add it. Okay, so you could utilize it for a special project. So we talked about the first that there might be something in the study that, maybe you don't want to use the funds because you feel you can be short. So you might want to use some of the surplus for that. And very commonly we say, you can use that surplus for the betterment of the association. Sometimes there's enhancements that the association would like to do and just don't have the funds to do it. Maybe you want to enhance that fitness center. Maybe you want to, buy a lot of new gym equipment. Solar panels has been something that we've seen purchased. You might want to actually upgrade landscaping. You might want to, buy new pool furniture. So it's a chance to say, look around the association and say, all right, I have this surplus now. What can I do with it? And can I make the association look nicer? Or can I buy something that I didn't think I had the funds for? So that's another use of the surplus. All right, so we talked about utilizing the surplus and spending it for various things. Now, if your surplus isn't spent, there are tax implications. So hopefully I'm going to be addressing those questions that are coming in on the tax implications. First, we'll just give a little background. Associations, not cooperatives, but just condominiums and homeowner associations, they can file either a choice of forms. They can file a Form 1120 or they file a Form 1120H. I'm not going to get into too much detail on it, but just a little bit of an overview. So in filing Form 1120, that's a regular corporate return, you must defer the operating surplus. If you don't defer the operating surplus appropriately, and I'll get into that in the next slide, then it can be considered as income and subject to tax. So it's very important that if there is an operating surplus, it's deferred appropriately. Any association can file this form, and the tax is a graduated tax starting at 15% and goes up. Form 1120H does not track the operating surplus. It really focuses on income, and it's considered exempt function income and non-exempt function income, so there's a different definition, and it doesn't look at the surpluses and does not track them. However, the eligibility to file is based on meeting certain requirements. It is a flat 30% rate, so potentially the tax could be higher. However, if you have a large surplus, we often will recommend that you file the 1120H. Maybe you pay a little bit extra in tax, but it protects the surplus. So those are the two differences in forms. So we're going to go back to the 1120. Now, if you have a surplus in membership income and you don't defer it to be used in future years, then it just could be considered membership income, regular income, and be taxed. So that, could end up with the tax issue. Additionally, in filing the Form 1120, when we talked before about the contributions to the replacement fund and making sure that you do it appropriately, any contributions to the replacement fund, for them to be considered capital contributions and therefore not subject to tax, pretty much have to follow the guidelines for what the IRS considers as a capital contribution, and all contributions, unit owners must be notified of all contributions, and that's really through the budget process. The contributions for the replacement fund, all of that really needs to be put into a separate bank account and segregated, and it should be based on something, so usually the engineering study. So there's certain requirements, so that's why when we say, if you're going to add something to the replacement fund, it's got to follow the guidelines so that it's treated as a capital contribution. If it's not treated that way, it could then taint the whole replacement fund and subject that to tax. So that's the tax implication. If it's not treated appropriately, any contribution to the replacement fund, then it could potentially taint that replacement fund and make that subject to tax. For an operating surplus to be deferred, there's no real strict guidance. However, there's been a revenue ruling, and it's Revenue Ruling 70-604, and it's stating that in order for a membership surplus to not be subject to tax, it has to be deferred in accordance with, pretty much following this revenue ruling. And the revenue ruling is such that you pass a surplus resolution to show the surplus is being utilized in the next year. The surplus is supposed to be passed by unit owners and affirmed by the board in the form of a resolution. You don't need to put any amount in the resolution. So if you know you're at the end of the year and you know you're going to have a surplus, well, you can just file the surplus resolution, pass the surplus resolution, and just state in it that any surplus will be deferred to the next year. These elections should be done prior to year end. However, they should absolutely be done by the filing date of the tax return. Now, it's not just enough just to say, okay, we're going to pass a surplus resolution and defer the surplus. You must also include that surplus in the next year budget as a surplus carryover. So it should go in as income and any related expenses against it. That way it shows to the IRS that yes, in fact, you really are deferring the surplus and using the surplus. So, there are some requirements, and you need to be careful that if you do have a surplus, you want to make sure that you are taking all precautions to defer the surplus in accordance with whatever guidance we do have from the IRS so that it's not subject to tax. If those things are not done, then we're always, recommending let's make sure we file that 1120H because we don't want to risk the surplus being taxed. So hopefully that answered the tax question. If there's any others, then, just feel free to shoot us a question in the question pane. All right, so I think I covered this. You know, we want to make sure that it's done correctly. Otherwise, it could be included as revenue. So additional contributions to the replacement funds we want to do correctly so that it's not considered as taxable income. And any surplus in the operating funds, we want to defer it so that it's not considered as operating income and tax. All right. So we'll just kind of go through a little summary just to make sure we're all on the same page and wrap up what we want to say.
All right. Thank you. So Carol and I have talked about the importance of an operating surplus, the implications that they present, and the many different ways out there to utilize these surpluses. Again, having a surplus is a great situation. You just have to make sure that that surplus is monitored so it doesn't become excessive and difficult to manage. Just like anything else, it's easier to manage on bit-sized pieces. Once it becomes too big, then it gets difficult to use it.
So I was just going to, sometimes the surplus, you mentioned this a few slides ago, Jordan, that a surplus might be due specifically to an expense that wasn't incurred. So, sometimes that's like a really large, or maybe it's like, a one-time income. Or let me first, the expense that didn't occur, but it's going to occur, then, we still want to make sure you bring that and defer that the next year, but then just up that line item in the budget so that that surplus is just applied to one specific line item or cost.
That's absolutely right. Sometimes things do happen, only in 1 year and may not occur next year, or you may need to update your budget to include certain line items. An operating surplus gives the board the ability to fund projects and enhancements for the betterment of the association. This is something, for all the unit owners that live there, they want to, have an association that looks great, and it's a really good situation to be in when you could look internally to fund these projects without the need to drastically increase maintenance assessments or pass special assessments to fund these projects.
Yeah, that's probably the best part, is everybody hates a special assessment, so everybody, if they know they're free from special assessments. That probably makes everybody happy.
Yes, and that's kind of what we said there. Even taking out loans, if you could look internally and use that surplus, that's something that will really benefit the association. Just make sure, as Carol talked about, that the proper steps are taken to mitigate the possible risks that the operating surpluses present. Some operating surpluses are rather large, and if that ever got incorporated into the tax return, it could result in a hefty tax bill. So you just want to make sure that you're taking all possible steps to mitigate those risks. And
again, that's why often, we'll say it's better to pay a little bit extra tax and pay a higher tax rate, filing the Form 1128 when it protects your surplus. It's always a good protection. So, it's always something to think about.
Right. Is that it?
I think that probably wraps up what we were going to say. I think there was another question.
There was one more question. How do we deal with the working capital fund? What does that have to do with the operating surplus, or is it an operating surplus?
The working capital fund is really an extension of the operating fund. So you could kind of look at those two funds as one. So that working capital fund, if there is a surplus in there, that can be considered an operating surplus and can be utilized by the board.
Exactly. Yeah. Sometimes that operating, that working capital fund can really grow. If an association has been around a long time, then sometimes that working capital, just payments on resale, will build up enough that you've always got a good surplus there. But even if that working capital then gets to be too large, then you might need to use some of your working capital.
Right, because that is considered an operating fund for tax purposes.
Absolutely, yeah. So you can consider using that. Yeah.
All right. Well, we hope you enjoyed the webinar today and was able to take something beneficial out of it. Any other questions?
Here's all our contact information. Feel free to reach out, and if any questions come in that we weren't able to address, then feel free just to send an email and we will address them.
And don't forget, the webinar is being recorded and will be on our website. In addition, you will receive the PowerPoint presentation via email. And lastly, if you could please fill out the survey when you do receive that via email. We really do appreciate your feedback. Any other questions?
Okay. Thank you very much.
Thank you.